Right. So, last week, what did we learn about? Where did we finish last Friday's lecture? We talked about intertemporal choice and how that tilts the budget constraint for your consumption today and consumption next week or next year, whatever. Then we talked about how that affects the relative well-being of lenders, borrowers, which we should all be able to derive, by the way. There's nothing new on that. I don't want to cover any more material on that. But now, so there's one more thing that I wanted to cover before I'm talking. Now, intertemporal choice, as I said at the end of last week, is at the backbone of finance. Finance is what enables intertemporal choice through lending and borrowing. I think that's one thing, that's what we cover in the first week when I take a graduate course on financial theory seminar, right? Now, the problem is, what we learned last week only took into account of the effect of change in consumption without allowing for the possibility that price might change in the meantime as well. In other words, price of consumption may be more expensive. Also with income. In other words, inflation. Yeah? So can we generalize the model to incorporate inflation? Well, yeah. So what we generally do then is we normalize the price of consumption of one period. By normalizing, I mean we make 1 to be 1. Then we take the relative value of another period's consumption. 항상 1로 하고 그 다음에 2에 대해서는 relative. 그 1에 대한 relative만 알면 된다는 거죠. So what we do is we take the price of consumption in period 1 and income of period 1 to be 1, and then period 2 price level to be P2. So what you would do here is essentially your second period budget constraint is now going to be given like this. What you can spend in terms of consumption is now consumption multiplied by this more expensive price. But in that sort of world, you get more income generally, more nominal income. Yeah? It's quite unlikely to be the case that you get double the price, but your income stayed. Actually, that's basically what happened in Korea over the last 15 years. If you see, there's a Korean variety program for those of you who are not familiar called 체험 삶의 현장. There's been a thing going around Facebook and Twitter a couple of weeks ago saying how the price of wage that they get in 체험 삶의 현장 in about 97, 98 is actually still the price we get now in 2015. So in that case, that's a huge fall in relative real wage, I guess. 실제 소득으로는 엄청 떨어진 거죠, 그러면. 17년, 18년 전에 뭐 버스값이 600원 하는데, 그죠? So, plus 1 plus R, but M1 and C1 are not multiplied by P2. Why? Because they're determined in period 1. When the price of consumption, when everything, 물가가 그냥 0이었을까, 1이었을 때니까요. So when that price level was 1, you determine how much to save, but consumption and income in the second period are subject to inflation, basically. That's what I'm saying. That's what I mean by this constraint. Okay? Then, what do we have? Obviously, we can do this. I haven't done anything else. Just divide everything by P2. Okay? Now, recall that P1 is 1. Yep? So, P2 is 1 times 1 plus pi, inflation rate. Yeah? That has to be true as an identity. Has to be true by design. So we have this. Yep. And we can have something like that. So our budget constraint is now given by something new. Okay? It's 1 plus your nominal interest rate divided by your 1 plus inflation rate. What does this mean? 1 plus rho, if we define rho as the real interest rate, then it's like this. So, or if you know that log of 1 plus x is very close to x, what does this become? Rho is very close to log this minus log that. That's very similar, using that. Yeah? Nothing new about that. I mean, that doesn't work if it's like, if your interest rate is like 27%. But in this day and age where inflation is like 2%, your interest rate is like 1%, whatever, your log approximation works pretty damn well. Okay? So what that means is, essentially your interest rate, the nominal interest rate that you sign with the bank, has to take into account the fact that there's going to be inflation. Yeah? So it's like this. Suppose that you're living in 2% inflation world. Okay? Gradually price grows every year by 2%. But your bank suddenly offers you, it's hardly ever likely to be the case, but suppose that the loan rate on your bank loan is 1%. In real terms, the bank is actually paying you to borrow. Because you're borrowing that you get, what you repay to the bank in real terms is smaller than what its value is going to be when inflation is taken into account. 그죠? 인플레이션이 2%인데 1%의 이율로 빌려준다. 그 얘기는 1년 뒤에 돈 갚았을 때는 마이너스 1%의 실질 이율이 마치 내가 돈을 받으면서 빌리는 것과 같은 효과를 낸다라는 거죠. Even if you don't do anything with that money, you can buy something more next year, in other words. Yeah? So that rho is different from nominal interest rate. So rho is measured in terms of real rate. Real rate. It's essentially telling us how much extra consumption we would get in second period if we give up 1 unit of consumption today. So it's nothing difficult about it. That's very, I guess, very standard. The fact that your interest rate has to be adjusted for through inflation to be in terms of real terms for consumption tomorrow and consumption today to be compared properly, that's a simple enough proposition, I guess. Yeah. So that's one thing I wanted to cover, but again, as I said, that's not that difficult. That's a very simple idea, I guess. Now, but something that I wanted to talk about more is on present value, because we're finance guys. This is microeconomics 1, not just microeconomics 1, but microeconomics 1 for the finance department, the finance people, primarily. So, the present value means a lot to us. Getting $1 today and getting $1 next year doesn't mean the same thing to us. Why? Okay, that too, but by placing something less than $1 in a bank, you generally earn interest on it, and you can make it $1 next year. So, in other words, $1 next year is worth less to you today. Yeah? So, the same logic can be extended to many, 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 many periods. Assuming constant interest rate, you get something like this. Second period consumption will be discounted once. Third period consumption will be discounted twice. Why? Because you put money now, and in a year's time, you put money again with the interest, reinvest the interest. 재투자해서 복리를 챙기는 거죠. And then compound interest rate wise. So assuming interest rate is constant, you get a formula like that. Assuming it is not, then you get something like, obviously, this. But we've seen that before. But again, this is like the very basic stuff, the very first few weeks of financial management lecture. So nothing difficult about it. But now you know that that derives from your optimal choice, intertemporal choice as a consumer. That's why there's a very microeconomics orientated view of asset pricing that is really popular in certain areas, especially in Chicago, where John Cochrane is. That's the view that they take. People optimize over present and future, and the asset price that you get, your price of bonds, your price of stocks, your price of everything, is a byproduct, a result of that intertemporal choice. So those people tend to view finance sort of as a subfield of economics, if you like. I don't agree with that, but if you take that view, then economics really can be seen as a subdiscipline of finance. I think we've covered this in financial management before, but this is important. Present value is the only correct way to convert a stream of payment to today's dollar value. Now, calculating present value is obviously, there can be a lot of confusion and difficulty. What's the correct R? What's the correct opportunity cost on your investment? You can have a debate on that, obviously. Yeah? I mean, that R can be put in a bank, or that R can be put in another various risk-adjusted, nice project that's supposed to yield higher return, then that's the correct way to discount. That's the discussion for the finance class. But what I'm saying is, you can't dispute the methodology of it. 방법론적으로는 PV만이 맞는 거예요. 그 PV에서의 R을 얼마로 측정하느냐에 대해서는 당연히 디베이트를 할 수가 있죠. 뭐가 맞냐, 뭐가 틀리냐. 그거 배우자고 우리가 파이낸스 하는 거고요. But present value is the only correct way. What I mean by that is, suppose you are a consumer that really sort of lives for today. Yeah? You don't value future consumption that much. You have in sort of behavior finance area, we call it very strong hyperbolic discounting tendency. So if a normal consumer's value of today's consumption against tomorrow's consumption goes like that, some people are like this. You know, the people that we see gambling in Gangwon-land, living for today, or some people who are, well, I mean, our children, really. My daughter, for example. She doesn't think, okay, so my dad, like, I had to basically talk with my dad, my daughter for 20 minutes before she let me go to work today. It doesn't matter that I'm going to come back at 6 p.m. and just going to play with her for 5 hours straight before she goes to bed. I don't know why she's suddenly got this 8-hour sleep regime, but people can have different tendencies. Some people will value today's consumption a lot higher, which means the discount rate is high. Yeah? For some people, R will be 1%. For others, R will be 20%. I don't care. Once you have the right R for that right person, in other words, what the rate at which he can lend and borrow, consumption today for consumption tomorrow. So can you see why, by the way, at this point, can you see why that might be different across people? So suppose that without prejudice, Kim Tae-young 학생 is exceptionally good in terms of credit quality. He doesn't go to the bank. PV comes to him, private banker comes to him and says, and then just give him a nice cup of tea, give him a brochure of stuff, and then loan rate will be extremely low. For him, lending and borrowing can be done at a really cheap rate. But for others who have to wander around the wilderness of Russian cash and other places like that, R will be a lot higher. So that can also factor in. But once you have the right R for each person, regardless of your preferences, you must prefer an income stream with higher PV. It doesn't matter if you prefer today's consumption a lot more than tomorrow's consumption, whatever. That's all in R. And the right R for you has been determined. Then, from there onwards, it's a question of comparing income streams of different PVs. You choose the income stream of the highest PV that you can. If I were to offer you a consumption stream that is higher in PV, or an income stream that is higher in PV, you must choose that. You might think that a person with a lot more preference towards present than future might not do that. No, that's not true. You have to make the right lending and borrowing decision yourself, and once the PV is established, you must choose the highest available one. Then you must do the rest of the job. It doesn't matter if the income stream is skewed towards the end of your life. It might be someone like 우리 한대건 학생, for example, again, without prejudice. Suppose that his income stream is going to be like about $5,000 for the next 20 years, and then 50 million from age 50 for every 15 years. But suppose the 한대건 학생 is one of those people that lives for today. Doesn't matter. He must prefer that income stream that is skewed to the future, but with higher present value. Do you see that? It doesn't matter that the consumer prefers present to the future. Now, income stream that is really high later on, you don't like it if the PV of that were lower than another thing. But if that PV is really high, I mean, like, he's going to get $50 million for sure for 15 years every year, then he must borrow against that. Yeah? Now, you might think, but he can't borrow, can he? There's no credible way of committing that. 어떤 은행이 20년 뒤에 50세부터 나오는 50세부터 500억씩 매년 번다라는 그거를 믿고 빌려주겠습니까? 질문할 수 있죠. You might think, who would lend to him knowing the income stream is going to arrive in 20 years' time? Yeah? But then you have calculated your PV wrong. Yeah? The PV must take into account of the fact that he has access to it. If he doesn't have access to it, then that R is the wrong R. So you have calculated your PV wrong, in other words. In other words, if he can't borrow against his 50 million income next year, not next year, from when he turns 50 onwards, his R is basically like infinity. The income that will come in 20 years' time doesn't matter to you at the moment. So that's what I mean by the correctness of the methodology. You can have argument over its calculation, technique of calculation, but PV as a methodology is fail-safe, fail-proof, foolproof. It's the right thing to have, okay? Even if you're someone that prefer tomorrow's consumption to today's consumption for some reason, you're one of these frugal people who want to have a nice retirement life, but you will choose this income stream over that, even though it gives you less income higher on. Because you take into account of your PV, you will do the right lending and saving yourself. What I'm giving you is, I'm going to choose the highest, if you like, endowment point in terms of PV, then the rest is my job. Finding the optimal consumption point is up to me through lending and borrowing. But I have to choose the right income stream, the right opportunity that will allow me to lie on the outermost budget line. It seems like an obvious point, but that's not. Generally, people get confused about this extremely easily, okay? A consumer that prefers consumption today doesn't mean that he must prefer income stream that is skewed to today. That's only true if its PV is higher, okay? I think I've said enough of this again and again and again now. So when we have the PV, sometimes you must buy an income stream by making a stream of payments. Then comparison of what you receive, PV of that, minus the PV of what you have to pay is what we see again and again and again in finance, NPV, net present value. Yep. 순현재 가치죠, 우리말로는. And that's why we are always fixated on this idea. And why have I spent so much time going over this? Is because we, as finance people, now think about how our finance management lecture in our first year or in your 제목 관리 언제 듣나요? 참 헷갈리네. 지금 듣고 있나요? 2학년 1학기 때? Okay, so you're concurrently taking financial management. That's the wrong way to design a course, but anyway. So with us. But my point here is, think about now, I mean, NPV calculation is right at the front of financial management. It's done in the first few weeks. You've covered this, right? But my point is, think about, go back to, let's recap our memory of how our professor did the motivation for that NPV. We talk about lending money, so putting money in the bank, comparing it, and stuff like that. And that's how we motivate and calculate NPV, right? What I'm telling you is why I'm going over this again and again here in economics is that has its firm basis on you as your consumer, you as a consumer making intertemporal choice of consumption today and consumption tomorrow. That's where the NPV has the economic basis and economic grounding. Okay? So NPV is not just an abstract concept of comparing income stream here and there and everywhere. It's a byproduct. Once again, what we use, demand curve, what we use, supply curve, what we use in terms of NPV is a byproduct of you making your choice as optimal economic agent. And that's what we set out. When we set sail for this course in week 1, that's what we said we had to do. How do consumers make optimal choice under constrained circumstances? NPV is a byproduct of doing that. So we have stuff on bond. The lecture is actually strikingly similar to what I was teaching the graduate class yesterday morning, actually. But we have, we can calculate the present value of bonds and consoles and stuff like that using this formula as well, right? So if you get a coupon bond, if you buy a coupon bond that is US government, for example, if you buy a long-term US government bond, it's saying 5-year bond, I'm going to make a quarterly payment to you in interest, So suppose it's 5% on $100, then that's $5 every quarter, March, June, September, December, for 5 years. Then at the end of 5 years, I'm going to repay the holder of that bond the original amount, the principal. So the correct way to discount that is exactly like this. But we have something also called consols or perpetuities, which are something that doesn't make intermediate interest payments, then only pay the original principal at the end. But generally, it is sold at a discount to begin with. So it will repay back $100, but initially it's sold at, say, something like $85 or $90. That's one extreme. The other extreme is something called perpetuities, or in Korean, 영구채. 들어보셨죠? What is that? It's where you don't ever repay your original principal amount. You pay interest again, again, and again for infinity. This is an OCW lecture, so I'm trying not to make reference to individual companies, but Dusan Infraco, for example, have experienced a lot of trouble with this. The consoles are classified as capital, not debt. So that makes things more difficult to, that gives companies room for leverage. But if you're interested in that sort of stuff, then corporate finance lecture will always have a section on this console. Okay? So how do you value a console? You buy that bond for, say, $100. Yep. But it's going to make infinite amount of payments. Yep. Infinite amount of interest payments into the perpetuity, but it's never going to repay your original principal. So what's the correct price for it? Well, so suppose it makes interest payment every year, then it's like this. The present value of that income stream into perpetuity, into infinity, right? Now, if we take x out, what do we have? What's this called? 그렇죠. 우리말로는 바로 이게 단어가 나오죠. 영어로가 뭔지가 몰라서 문제죠. 우리말로는 무한 등비급수라고 하고, 영어로는, or in English we call it geometric sum to infinity, with the common ratio of 1 plus r, 1 over 1 plus r. So in that case, the formula to sum it up is given by that, which once you calculate, it becomes x over r. But the reason why I'm going over the seemingly finance material in economics is to give you a bearing on how we as consumer making intertemporal choice relates to the asset valuation of what we sell and buy in financial markets. Now, and then you get hugely interesting results if you allow that discount rate to vary over time. For anyone interested, my behavior course will talk about that time-varying discount rate week after week after week. Choice of the interest rate I've already talked about, so I'm going to skip that. Now, then, chapter 11 of our textbook gives a very brief introduction of asset markets. Like, if you read through that chapter, you'll feel like you're being treated, your intelligence is being insulted almost. Because for finance majors, this is such a simple material. Especially if you're a junior year or senior year who have taken a number of financial management or asset pricing related classes, then this is an incredibly simple material because we don't even talk about uncertainty. But let's go through it at least anyway. Now, today, for the next 20 to 30 minutes, we're going to talk about asset markets, the financial markets, under the basis that there is no uncertainty. You know what's going to happen in the future. Next week, Friday onwards, we're going to talk about uncertainty, how that relates into the asset market. Now, suppose there's an asset that repays P1 for certain with the current price of P0. Well, if you define that rate of return as something called R, then this is equal to 1 plus R, because the definition of your return is P1 minus P0 over P0. Yeah? So that's the return on your investment in that particular asset. Now, suppose that there's another asset that yields R. I should be something different. Interest rate of R. So let's just call that M or K or something, okay? What should the rate of return on two securities be like? If you know that they are both riskless for certain. 확실하게 안다면 둘의 수익률은 어때야 됩니까? 확실하게 위험이 없다라는 거 아니에요. A도 위험 없고 B도 위험이 없다면. They must be equal. Yeah, it's like this. It's like this. Suppose that the same bank with same characteristics, riskless, whatever, offers two different current accounts. One that pays 0.3% interest, one that pays 0.6% interest. You're obviously going to take the one with higher interest rate. Yeah? It's like that. That's arbitrage. That's called the arbitrage or 차익거래. If not, if the price of today, the asset A's current price is too low or too high, what are you going to do? You're going to sell or you're going to buy until the return on two securities are equal to each other. They're same in all characteristics. Why should they have a different price? They shouldn't. 똑같이 위험 없고 똑같은 페이먼트를 주는 완전히 완벽한, 완전히 똑같은 세큐리티인데 가격이 달라요. 말이 안 되잖아요. Now, we as human beings make mistakes on that, and in behavioral terms, generally, human beings are prone to mistakes on this, but assuming rationality, the arbitrage must hold. Yeah? So the price must equal. So no arbitrage. So what that means is, if you rearrange that, if you multiply it to here, divide that to here, your today's price is what you get paid back tomorrow, discounted by 1 plus R. So we can think of, now today's lecture is basically on present value. That present value is the optimal byproduct of the people's optimal choice. But at the same time, what ensures that optimal choice to happen is arbitrage. If two securities with identical characteristics sell for different prices, we are going to equate their returns through buying and selling. 차익 거래를 통해서 사고 팔고 하기 때문에 PB가 맞아떨어진다는 얘기예요. So present value has its meaning, its correct meaning, through the workings of our financial market. That's why the economics and finance overlap and become interrelated at this point. The PV equation is important from economic perspective. Yeah? But methodologically wise, what ensures the holding, or if you like, what ensures PV will hold true in reality is given by the workings of arbitrage forces in the financial market. 그죠? 금융하고 경제가 그렇게 연결이 되는 겁니다. But obviously, in reality, there are two main reasons why one asset may trade at a different value to another even when it promises the same payment in the future. Yeah? Suppose that there's a company that you haven't even heard of in the US promising high dividends in the future. And suppose there's another company, which we all know, say Microsoft or P&G, who, by the way, are both AAA rated, promising exactly the same dividend stream. You're going to choose Microsoft. You're going to choose P&G because it offers you less risk. And also, there's another component called liquidity. So essentially, the one asset being traded at a cheaper price than the other is down to two factors, either risk or liquidity. What is this liquidity, or 유동성? It's how easy you can sell that asset without incurring significant cost to yourself. Now, suppose that you put all your money in real estate, in a really risky venture, then you suddenly need cash. Suddenly you're strapped of cash. Can you sell, say, 7-house pension or 3 apartment blocks overnight? No, you can't. So what you have to do then is you have to offer a cheaper price, a lower price, to search for potential buyers quickly. Or in Korean, 금매. 억하심정으로 눈물을 머금고 매물을 내놓습니다. Yep, that's the lack of liquidity at work. So, that's the easy part. That's what we know all as finance people. But there's something else that I wanted to draw our attention to. There are something called consumption returns as well. Now, that seems like a very abstract concept, but it's something that our parents and we all know. Okay? Most assets pay off only in money. Stocks pay dividends. Bonds pay interest. But think of housing. It doesn't pay you off with everything. It doesn't feel like, suddenly once every quarter your living room floor suddenly coughs up money or anything like that. 그럼 되게 웃기겠죠? 거실에서 갑자기 확 하고 돈이 튀어나와. 그러면 웃길 것 같지만 현실은 그렇지 않습니다. So, housing pays off in terms of consumption. What I mean by that is, the fact that housing doesn't give you money doesn't mean that you don't derive any return from housing. They're different. Why? Because it's a very simple principle. If you own a house, you don't have to pay a rent to another person. It's just like paying the rent for your own self. In other words, you could have rented that house instead and paid someone, say, 1 million won a month. You don't do that. You buy a house. Then you're essentially implicitly making a saving of 1 million won per month yourself. But also, in other words, you can think of it another way. You could have lent that house to another person and received 1 million won, but you don't do that. You live there yourself. So the fact that you're living there must mean that you're deriving at least 1 million won's worth of pleasure. Yeah? So suppose this implicit rental payment is $T per dollar. $P per year. Then the fact that you own your house essentially generates you with an implicit income of $T. The money that you would have had to pay if your house was owned by someone else. I mean, we talk about these terms of house pool and stuff like that, yeah? But suppose that okay, let's put it another way, okay? Now, for those exchange students, Korea has two different rental systems, 전세 and 월세. 월세 is like monthly rent payment. That's the stuff that you know. Do you know how 전세 works? It's when you make a huge lump sum payment to your landlord, don't pay anything, then get that money back 2 years later at the end of the contract. But in the meantime, the landlord can use that huge lump sum money to, I don't know, put it in bank somewhere or something like that and generate income for himself. Yeah? Yeah, you get all the money back. So if you put in, say, 400 million won, you get 400 million won back. But that's what I'm just trying to get at there. Okay? Now, at the moment, there's a huge preference for 전세 over monthly payment because currently at the market-wise in this area of 서울, 월세 전환율이라고 들어본 적 있습니까? The rate at which you can convert that lump sum payment in 전세 to a monthly rate payment is about 5%. Yeah? But the bank at the moment is only offering you in the top end of the region 1.x% when you deposit that money in savings account at the moment. At best, you get about 2%. Yeah? So, by choosing to live in 전세, if you can, finding a thing is a hugely difficult task. You're essentially saying, if I were making monthly rent payments, I would be paying a 5% rate. But I'm not. I'm not doing that, am I? I've got that money on loan from bank. Generally, people do. In my case, I certainly do. And that loan is at, say, 2.5%, 3% or something like that. But that's still a lot cheaper than converting it into monthly rent payment, which is currently being at around 5 to 6%. So if you can obtain loan for cheaper, in other words, if you have a good credit score and you can get housing, the collateralized loan at about 2.5 to 3% currently, that's the going rate, you're essentially implicitly making 2% to 3% saving on your income. That's implicit income to you by living in 전세. That's why there's a huge demand for 전세, but no landlord is willing to provide one. Yeah? So why that 전세 persisted was in Korea until recently was this. That implicit income fell and fell and fell, but the value of house appreciation, 집값이 오르잖아요. House value rises. That gives you additional income, if you like. Yeah? So the total rate of return on your home investment, if you bought a house, is A, not making a rent, plus the appreciation value of your house. Yeah? If you're making rent payment of 1 million won a year, that would be exceptionally good. So 1 million won per month. You're basically, it's like an additional income to you of 1 million won. Plus there's appreciation, house appreciation. That's another additional source of income. You can sell the house at a higher price. That H must be equated to the rate of return on other financial assets, like putting money in a bank or something like that. If R is greater than H, then you're better off putting your P dollars in bank and just pay rent. That's why people are not choosing to buy houses a lot at the moment. Yeah? while the bank interest rate is low, you think the housing appreciation is going to be even lower. 집값이 안 오를 거라고 생각하면 거의 0이잖아요. So you prefer to live just on rent. That's what we Koreans are suddenly becoming like at the moment. Obviously, if you're the other way around, if the bank rate was lower than H, people flood into the housing market to raise the housing price. But even with that, Korean housing market boomed for 20 years on that basis. So that simple equation, that one simple equation tells you a lot about what's going on in terms of our life that we will build over the next 20 years. Housing is one of the most important decisions you will ever make. So this is a simple guidance to you, I guess. The rent that you make, you don't have to make rather, plus the expected appreciation of your house price divided by the price at which you buy that house must be equated to the return on other financial assets. Obviously, that A is the most difficult thing to calculate, whether the house price will go up or not. You have to make a judgment yourself. People make wrong decisions, people make good decisions, but the principle is simple, okay? Now, I'm going to end the lecture by talking a little bit about financial assets a little more. In the US and in Korea as well, the tax office in Korean case and IRS in US, Inland Revenue Service, distinguishes two types of asset returns for tax purposes. The first is income. You know, if you like, dividends you get, interest you get, etc., etc. So if you invest in, say, Samsung Electronics, Samsung-전자, get some dividend off it, you get taxed on that. That's like income tax, almost the same ordinary tax rate as what you would pay on your ordinary labor income. But cap gains is another thing. Capital gains is if you bought Samsung-전자 at 1 million won a share and you sell it at 1.2 million won a share, you get taxed on that too. So you get taxed twice, if you like. One for your cash stream, and once when you sell the stock of that share at a profit. But it only becomes taxable, 세금이 실제로 매겨지는 거는요, when you actually sell the share. The fact that you're holding the share at a higher price doesn't mean you're going to be taxed. Only when you make that sell decision, 팔기로 직접 나 팔겠습니다라고 주문했을 때, when you place that sell order, you get taxed on that. But the law, US law, and that's hugely complicated, but cap gains are generally, at the moment, taxed slightly more favorable rate than the labor income. But there are two complicating factors. First, remember that cap gains are taxed only when you actually make a gain, when you actually sell the damn thing. So you're able to defer the tax longer and longer and longer until you make that sale decision. Obviously, you take risk by refusing to sell at a profit now, but assuming that that profit remains, you're making profit, but you're deferring tax until later and later and later. So when that's calculated around, that generally lowers the effective tax rate, but the problem is capital gains tax are taxed at nominal gains. What that means is, if you bought the Samsung-전자 share, Samsung Electronics share at 1 million won, but sold it at 1.1 million won, 110만 원에 사요, then that's a 10% gain. But if the price levels also went up by 10%, in real terms, you gain nothing. Yet you get taxed on that. The tax is not inflation adjusted. So the effective rate is higher for one region, lower for one region. Generally, so for people, you have to make a lot of complicated decisions. But at the moment, inflation is at a rock bottom. So generally, cap gains, investing in stock market is actually a profitable activity in terms of taxes at the moment. Because what raises the effective tax rate is the inflation. But currently, inflation is like 1%. So that's partly explains the incredible rush into the stock market that we saw over the past 2-3 years. And then, now, that's one thing I wanted to talk about at the, for the next 5 to 10 minutes and then finish the lecture. I wanted to give you an example of a present value, importance of a present value, okay? Now, suppose that you're a lumberjack or you're a paper company. You have to build a forest and you have to cut it down and make some money off it, make paper or whatever. Suppose the size of the forest, measured in terms of the amount of lumber that you can get, is some function of time. If you let it go, if you let it be, it's going to grow. The forest is going to be bigger. 숲은 자랍니다. 그죠? So, but suppose the price of lumber is always constant. Okay? Moreover, the rate of tree growth starts high. So if you leave it, the forest grows really quickly at first, but it grows really slowly. When should you cut the forest and get lumber? The answer for that is the present value of your forest is given by FT over the discount rate. The discount rate is if you were to put that money in the bank, how much would you earn? If the denominator, well, suppose the denominator is constant. If the forest is growing at a rate faster than what the bank is offering you, should you cut the forest or should you keep? Keep. What if the forest growth rate is slower than the bank's deposit rate? Should cut. So when should you cut? When should you make that decision? Exactly when the forest growth rate is equal to the bank's deposit rate that they're willing to offer. So today's lecture essentially was talking about present value and again, and how that relates to the world of finance. I mean, that example at the end was just to show you how the present value can affect a person's decision in real life. But that's such simple. Today's lecture is quite simple, but I wanted to give you an intuitive feel of where you are in terms of coordinates of the bigger picture. We are finance-based people. I mean, there's some people are not here. But yeah. Then we have to see why we are taking this damn economics course when we could be taking another course in asset pricing or something like that. Present value is the key link where the consumer's optimal choice across time relates to the pricing of the financial market. And that's where the present value is important. Present value is what you as a consumer will look at to optimize. Yeah. But that present value can only be ensured through the workings of the financial market, the forces of arbitrage, pushing price higher, lower, buying, selling. That's what equates the PV and holds that to be the true methodology in financial market. You take that across to economics, and that's the basis for an optimal decision of a rational thinking agent. That's why all the stuff that we have learned about consumer optimization until now becomes related to us as a financial management majors.